Mr. Yamanaka for the State Superintendent of Public Instruction, Mr. Prasad, Mrs. Yamamoto, Ms. Dillon, Ms. Hendricks, State Treasurer Fiona Ma, Ms. Miller for the Director of Finance. Thank you. Mr. Chair, you have a quorum.
Thank you. A couple of items related to the agenda that I'd like to address before we adopt the agenda. Firstly, item number 3, which is the asset liability allocation study. Item 3, which is scheduled for 45 minutes, is listed as an action item. That item will be a information discussion item today and not action. Secondly, as it relates to public comments, we will follow a very similar process that we've adhered to in July. After each item, there will be 10 minutes for the public to speak on the item that is being addressed. There will be 30 minutes for public comments for items which are not on our agenda. We're scheduling to take that 30-minute public comments prior to lunch, estimated to be between 11:15 and 11:30. We have numerous groups that have said that they will be here to speak with us on public comments. In the event that one or more of the groups are not present at the time that we're taking public comments, we will reserve some of that 30 minutes for public comments later in the day. So I think that is clear to folks. Okay, great. So with those two changes, I'll entertain with the one change and the comments about public comments, I'll take a motion to approve the committee agenda for the day.
So moved.
So moved. Is there a second?
Second.
Without objection, the amended agenda has been approved. Item 2 is the consent agenda item, which is the approval of the minutes from July. Was that July 2018 or July 2019?
Is there a
2009, well, Dana's rubbing off on me.
Dana's giving us her editorial juju.
Bill, usually I don't cash those things.
On the actual minutes, it says 19.
All right, so it's 2019 without any amendments or changes. Without objection, the minutes have been approved. Okay. Brings us right away to our asset liability, item 3, and that's a team presentation. And if it's okay with the committee, what I would prefer to do is have the committee throughout the day, the items be presented by staff, then for our consultants to comment on the item, and then open up for discussion and questions. Okay? Welcome, Geraldine. You want to introduce? We know everybody on the team, so welcome. Are you the lead on this item, Geraldine?
Yes, I am.
Great.
Yeah. So Geraldine Jimenez, Director of Investment Strategy and Risk, and yes, I'm a member of the Asset Liability Management team. This is one of the first years we've truly integrated both of those studies together. So everything we're presenting to you is helping to inform your decision-making regarding building your portfolio to actually pay benefits into the future. And a few key points to remind you of is this study is very much a long-term study. It's not about tomorrow or the next day. It's about 20 years out, 20 plus years out. How can we pay those benefits? There's a lot of quantitative and qualitative information that goes into it. You know, quantitative is expected return and risk, you know those numbers. But it's also what can we as a staff do and what do we think the markets will do in the very long term. On here you can see we are at the September item, and November, as Mr. Keeley just indicated, we'll have more modeling. So we're looking for a discussion today on what's important to the board to help fully inform everyone about this decision. We've told you in the past, over 90% of the risk and return variability will come from this decision. And that seems overwhelming, and it is really just that overwhelming. We can spend a lot of time on one strategy or one tactical move, but actually this will inform how we're paying our benefits into the future. So we want to make sure you have time to understand that. The other important point is on the liability side, notice there's an adopt actuarial assumptions. That is in January. So your decision on this asset allocation will inform that agenda item. So they are linked. But November puts us on a perfect plan to continue this link, and it'll make it work well. I want to bring back to some really basic concepts that are in our investment beliefs, and they're very much part of why, at the end you'll see we're making a recommendation, but since we're not making a decision today, but you can see our thinking and why we're bringing forward this portfolio to you. It's going to improve diversification. We want to keep focusing on that. If anything, in today's market environment where you can't tell what day to the next, what's going to happen, everything is, depending on a geopolitical environment, keeping that diversification is really important to CalSTRS as a fund as we move forward. The other thing is the illiquidity premium. So that means in the private assets, we think we have the ability and the skill to take advantage of that. Generally, there's extra return that comes with that. And we think as a long-term 20, 40 plus year investor, we can take advantage of that for our beneficiaries. And the final is in a market drawdown. So if you recall 2008, 2009, not sure anyone can forget it, but if you can recall that, we've built the portfolio already, risk mitigating strategies, and we continue to focus on not just that component, but the overall component. How can we protect and put perhaps a floor? We will experience this drawdown, but can we protect and get a floor so that we can recover faster and again, fund our benefits? So as you probably recall, we have these asset class, and I have the noble directors behind me that manage these day in and day out. But for this study, we decided to categorize them about what they do in the portfolio. So we have a growth component. You can see that. And again, over 60% of the dollars to pay our benefits are from growth in our portfolio. It's really important to CalSTRS to get growth. Then we have real assets, which offer us some kind of income and inflation protection. Well, if we ever get inflation, we will one day, but it offers that. And then we have diversifying that will behave differently in the market environment from a growth and help diversify the portfolio. So again, we mixed those up for this study. And this overall is kind of a picture. We took the information that we presented to you in May, which is our assumptions on the risk, the return, and how assets behave together, and we mixed them up, and we did lots of scenarios. These two gentlemen on my right did a lot of work on modeling both the asset and the liability side, and what would it look like. And these are all about predicting the future. This is still a best-in-class analysis, but we won't be perfect. But it's about examining all the alternatives and what can we do to best maximize our ability to fund. And just for some historical perspective, we've gone from a fairly simple 1980s, look at that, it's fixed income, that yellow, to US equities, to a fairly sophisticated, complex system and portfolio. We'll probably continue to make that complex portfolio even more complex with the collaborative model, more direct investing, again, to take advantage of opportunities out there for our beneficiaries. So right now I'm going to hand it over to actuaries, and he'll introduce himself.
Good morning, David Lamore, Deputy System Actuary. So I'll cover the next few slides and mostly kind of bring back some information you've already seen the last few times we presented to you, just so that everyone understand again the importance of this decision and what it means. And it's always good to look at this. We are here to serve California educators and make sure we can pay the benefits they have been promised. So really what we're trying to do is keep this little equation here in balance. Ultimately, we want to pay the retirement benefits to the teachers, and we collect contributions from the state, the employers and the members, and we invest them. And what we're talking about here with the asset allocation study is the investment income. And the main thing I want you to, this is a good way to sort of see what are the financial implications of the ultimate decision around the asset allocation. if we were to, for example, take less risk and have a lower expected return, that investment income bucket will become smaller and will have to be made up with higher contributions. A lot of the information you'll see later today will sort of show these trade-offs. And this is sort of my next slide here. A lot of what we're doing here, there's no such thing as a perfect portfolio that can achieve all of these things you see here. When you take risk with your investments, there will be, there may be situations that may lead to low funding levels. We may not be able to reach full funding. There may be situations that lead to higher contribution rates. Some of the information we'll show you later will help you see some of these trade-offs here. We're going to be focusing a lot on, are we going to be able to achieve full funding? What's the likelihood that we may see low funding levels? What is all of this going to do to contribution rate? So this is sort of the whole analysis we've done, is we've tried to kind of combine assets and liabilities together to show some of this interaction. And just as a reminder, this is something we've shown you several times over the last few years. With the passage of the funding plan, we are on track to reach full funding. And I just want to remind everyone that the slide you see here was from our most recent valuation, assuming that we earn 7% return. So this is the path that we are under right now. And then depending what happens later this year, the decision made on the asset allocation, we can update this, but we are on path to reach full funding. And the last thing, again, just to highlight how important and critical the asset allocation decision is under our current portfolio earning, where we expect to earn 7% long-term. If you look through the life of the funding plan, how are we going to fund our benefits? 61% will come from the investment income. And you can see that the employers will cover about 18%, 10% from the members, and 11% from the state. And the main point I want to make here again is if there was a decision to lower the expected return, that green component on the left would become lower and would have to be made up with higher contributions. And later on, Josh will show you who exactly would have to pick up that component. And with this, I will pass it to Josh.
Great, thank you. I'm Josh Diedisch. I'm a portfolio manager on the strategy and risk team, leading the risk team, working with Geraldine and part of the ALM team. So, we've come a long way in the study now with a lot of sort of building blocks in the first few meetings, and that's what you see here are the things that basically the major components that go into the decision and all the modeling that we do. So we do capital market assumptions, expected return, risk, and correlations, and all those returns are net of fees. We have this menu of investment options with the asset classes and strategic classes. We have the funding plan that David and Geraldine talked about a little bit. And then we, constrain private markets, the allocation, and we're going to talk a little bit about that because it's, I think, an important part of this phase. Now that we're at the point where we've had conversation about sort of your general, risk tolerance and the direction you gave us in July to come back with a couple of portfolios. Now we're showing specific, asset classes and the weightings there, and so the private markets are an important component of that. So the red box, we have this red box around the recommended portfolio. There's sort of a couple of changes here that we'll dig into. The major change, though, is shifting from public equity into real assets and a little bit in diversifying. One thing that I would draw your attention to here, because we're going to spend a little bit of time on it, is if you compare the portfolio that we have recommended to the lower risk portfolio, which is consistent with a 6.75 investment return assumption, you'll notice that the private equity, the recommended allocation, and the lower risk portfolio have the same allocation to private equity, real estate, inflation sensitive, and RMS. And the reason for that really sort of gets to why we're in those private markets and sort of this idea of diversification. So one way that we can look at the portfolio is sources of risk. So we have talked about this economic growth class, which is basically public and private equity. There's the allocation, but then there's also how much of the variation in our returns is sort of explained by these major factors. So the portfolio that we have, that we've recommended, that number is 82%, and that's a little bit lower than what our current portfolio is. But that's something we've talked about quite a bit, that we're really tied to economic growth. And what we can do is sort of do a thought experiment that assume that we couldn't invest in private markets. So let's take the portfolio that we've recommended and let's hold the same risk level and assume we could only invest in stocks and bonds. Basically, what would that look like? So in that circumstance, with that public markets only, the economic growth sort of exposure goes up even more. So essentially goes from 82 to 94%. So that's one sort of lens that we can look at this and the role that the private markets play in our portfolio. And then another way to think about it is, okay, we've assumed that we can't allocate to private markets, so which means we're not getting the diversification, we're not earning the higher returns that we expect from those classes, and we're only investing in public markets. That difference is about 70 basis points on the long-term expected return. So another way of thinking about this is by investing in private equity, real estate, inflation sensitive, and RMS, we think we can get about 70 basis points more of long-term return by investing in those markets. And this is all net of fees. I think that's a pretty sizable difference between those two portfolios. So the portfolios that we came back with the recommendation, we came with the lower risk portfolio, and then for comparison, the current long-term allocation, the recommended and the current are consistent with a 7% investment return assumption, and then a lower risk portfolio that drops that by 25 basis points. You can sort of see the contribution rates across there, and then actually looks like we lost our bottom row. There's an additional row in this PowerPoint that shows basically one more piece, which is the peak state rate. So the recommended portfolio, that peak state rate, the contribution rate, is about 8.8%. The lower risk portfolio is about 11.8%. And that's something that's going to be important in a slide or two when we talk about an adverse scenario, because it sort of gets at the heart of why we're recommending this portfolio versus the lower risk portfolio. And when you look at these on sort of the average metrics, they look very similar. So the expected funded status for the recommended portfolio, the lower risk portfolio, and the current targets are all very similar. But what you'll see is that actually that lower risk portfolio has a lot less cushion in a downturn or in an adverse scenario.
I did just want to highlight the two different member groups. I know we had this conversation yesterday. The 2% at 60 members, right, are vast majority, but the new members, 2% at 62, their contributions go up as we take risk off the table.
Thanks. Okay. So we showed a couple of visuals in July that I thought were helpful for kind of seeing the risk-return trade-off essentially. And these portfolios look very similar, but the recommended portfolio basically, if you look at that sort of middle dot, has a little bit lower risk of low funding than the current portfolio. Very slightly lower probability of full funding, but sort of in between there. And sort of similar when you look at this risk of low funding versus, this peak state rate, which is kind of a good measure of the contribution rate volatility that the portfolio would experience. So again, a little bit lower risk of low funding, a little bit slightly higher contribution risk, but significantly lower contribution risk than this lower risk portfolio that we've modeled, this 675 portfolio. So one of the major reasons why we came back with the recommended portfolio versus this lower risk or 675 portfolio really has to do with the idea of the cushion that's built into that portfolio. So there's a lot of different ways of thinking about this, but one way of thinking about an adverse scenario is that the portfolio earns 1.5% less than we expect for a period of 10 years, and then gets back to the return assumption. So what's the portfolio's ability basically to recover after a scenario like that? And so you can sort of see the lower risk portfolio in orange versus the recommendation. It doesn't quite get back to full funding. The difference in funded status is about 12%, but we can also put that in dollar terms. Basically, what does that mean over the term of the funding plan? That difference grows to about $54 billion. And so what that is really coming from is the fact that because of the constraints on contributions in the funding plan with the lower risk portfolio, there's just a lot less cushion and a lot less ability to essentially recover from that type of scenario. So that's sort of why the recommended portfolio versus this lower risk. And then another natural question would be why change from the current targets? And a lot of this gets at there's some of it's in the numbers, but a lot of it is in sort of the qualitative judgment of us as a staff, and talking with Makita and talking to the asset class directors and thinking about what we can do, and then just the kind of broader notion of improving diversification. That's really what this is about, is we think we can allocate a bit more, particularly to real assets, that'll stabilize the portfolio a little bit and diversify the sources of risk. And that's really what you see there, sort of in that right-hand chart. It's just summarizing, we're taking down our exposure to economic growth, or recommending that, and increasing real assets, and then a small increase to diversifying. And that's really sort of the gist of this portfolio, this recommendation versus the current. It's we're at a level where everything that we do will be sort of marginal improvement, and we think that this is an improvement over the current targets.
Thank you. To summarize it up, really there are many different portfolios. There are many different options. We're hoping to present you with information to help with your dialogue on what's important. I can list here what we thought was important, but because we will be back in November, we look forward to you letting us know anywhere you want us to drill down in. Again, our first bullet was we think this recommended portfolio meets the parameters of the funding plan. It keeps our actuarial return assumption, it lowers contribution rate volatility, and it gives us that cushion. We also thought, going back to the investment beliefs, we focused on diversification. We want to improve that in this new portfolio. We want to do more protection on drawdown risk. And we want to take advantage of the private assets in our collaborator model as we're building this out. We think over time we can pace into this and add value to the fund. Again, though, we look forward to your input. At this point, though, I'd like to turn it over to Makita as they opine and give us some thoughts also.
Good morning, Alan Emkin, Makita Investment Group. It's a pleasure to be here. We support the staff's recommendations, and just a few observations before you get into your discussion. Number one is to remind you and the audience that there's only one reason to have an investment portfolio, and that's to pay benefits. And it's just it's crucial to always remember that. If, in fact, you were fully funded today, we would urge you to take no risk. Get out of the investment markets and get out of the uncertainty and just walk away from it and be very happy. We all wish that could be the case, but that's not the reality. The next thing I want to highlight is that the actuarial side has a high degree of precision in their forecast on the liability side. Their numbers are really solid. On the asset side, there is no lack of, the numbers just are soft. And that's not because we don't have lots of data and lots of science. It's just that the capital markets are so uncertain. And most of the material you've seen today is based upon the average return. Well, 50% of the time, it's going to be less than that. And what we would urge you to do in your deliberations is not focus on the 50% of the time that it's better than that average return, but focus on the 50% of the time that it's not. The reason for that is that if it's on the good side, it benefits the plan. Everybody's happy. If it's on the other side of that, then you have to come up with solutions on how you're going to make up the variance between what you had expected to get and what you really got. A number of the assumptions, particularly in the private markets, that went into the model are very conservative. And we can discuss that at a later date or today. But it's just important to keep in mind that particularly for private equity, we assumed a level of volatility, which is a penalty, that is much higher than anything you realistically will ever experience, in part because of the way it's priced, but also importantly because we put down what we call an illiquidity premium in terms of risk, that we wanted to make sure that we weren't loading the model to come up with a pre-disclosed and pre-identified result. The staff has done an enormous amount of work, both on the liability side and the asset side, and the merger of the two, in our opinion, is superior to what we've done in the past. It's a very thoughtful process, and we do encourage you in November to adopt this, and happy to answer any questions you might have.
Thanks, Alan, and thanks to the staff. I think it's a thorough PowerPoint. I think you did an excellent job in communicating the why. So thank you for that. And I'd like to now open it up for committee members' questions or comments. And we'll start with Ms. Sharon Hendricks.
So first, I just wanted to say I've been on the board 8 years, and it's really great to see actuaries and investment staff together presenting. I think we've kind of been working towards this for a few years. So to me, it just makes sense, you know, kind of having our different staff sort of working collaboratively and presenting collaboratively. To me, I think it helps to strengthen the confidence we have. I think as a board, it's helpful to get all your thinking together in one presentation. So I appreciate that. I really liked, I think it's slide 4, they're not numbered. Oh, I guess they are. I think slide 4 to Harry's point that I think it's so helpful, especially with new board members, but I think for me too, to remember sort of when we think about asset allocation, what is the function of the different asset classes? And so I really appreciate the pragmatic, public equities for economic growth and real estate, just sort of what is the function that each of these asset classes perform in the portfolio, because I think for members of the public and our members, it's helpful for them to understand when they read about private equity sometimes and might have a perception about that, like why are we in private equity or why do we invest in real estate? So I think I appreciate the explanation around kind of what's the function that these different asset classes perform. So from an educator perspective, I think it just gets us down to brass tacks and makes it less complicated. I did have a question. I think, David, it's an actuarial one, which is, I believe it's on slide 14, I think, the contribution rates and funded status. That piece around the 2% at 62 members on the lower risk portfolio, that goes up to 10.705 because of the normal costs. Is that right? I just wanted to make sure I remember back to.
And just to put it in context for some of our new board members, this is directly related to the pension reform legislation that was passed by Governor Brown in 2013 that now ties the contribution rate for our 2 at 62 members with the cost of the benefit, not the unfunded liability, but the cost of 1 year of service. And if we were to lower our actual assumption by 0.25%, it would raise that normal cost by 1%, and the law says that members should pay half of that increase. So the best way to keep in mind is for every 0.25% reduction in the investment return assumption, the 2 at 62 member rate would go up by 0.5%, which is what we've shown here. The 2 at 60 member contribution rate is set in statute at 10.25.
So 10.25, 2% at 60 in statute will not change unless there's,
Unless
some
someone
legislation.
changes the statute,
unless somebody
yes.
changes it. But our new members hired after 2013, are subject to that normal cost change. And if we do lower the assumed rate of return by 1/4%,
Yes,
it increases the normal cost by 0.5%?
by
Or is that-
0.5%,
okay,
yes.
just wanted
And
to-
right now, we're talking about a quarter of our active membership. So we have about 450,000 active teachers. So about a quarter, just over 100,000 would be impacted by this.
So you're saying a quarter of our active members are 2% at 62
Correct.
members?
Today.
At this point? Okay. And just one last comment is just, I think it's so critical for us to keep our mind on the funding status. So Alan, what you commented on, and David, your comments earlier, I just think in the midst of all of this, I'm obsessed with our funding, and just making sure that we're doing all we can to obviously get that number from the 60s towards 100%. I'm glad to hear our plan's working. I know it is, but I think it's important to keep our eye on the prize. So thanks.
Controller Yi?
Thanks, Harry. Thank you for the presentation. I just had a couple of questions, and I know we're not taking any action on this today, but I was curious about an understanding that diversification is the goal with respect to the recommended portfolio, but wanted to kind of get a sense of the transaction costs of implementing the new portfolio and how that compares to where we are today.
Well, clearly there would be. That being said, if we adopted that portfolio, it would be adopted over many, many years, and we would be as opportunistic as possible in moving. So, I think Chris Ailman says we don't chase targets, so we wouldn't adopt that portfolio and be in there tomorrow and need to transact to get there. It would be very thoughtful and over time that made sense.
Yeah. If I could jump in and make a comment. Oh, sorry. My name is Scott Chan. I'm the Deputy Chief Investment Officer. And I think a broader point to your question, Betty, is the all-in transaction costs and perhaps the management fees and expenses that will be paid along the way. By diversifying the portfolio into real assets and shifting from global equities, you're going to be shifting into more expensive management of assets. And so what we've done, though, is we've modeled the returns net of the fees. And so we have a good sense of what the bottom line to CalSTRS will be. We feel very comfortable about that. But bear in mind that some of these asset classes are more expensive from the ones that we'll be sourcing the capital from. So I just wanted to provide that broader point for you.
Yeah, and that was the genesis of the question. So I guess given the high demand for quality real estate and investment-sensitive investments, are we confident that we'll be able to penetrate into those going forward?
Yeah, we feel very confident about that. We've looked at the long-term returns that we've been able to successfully generate, as well as looking at the industries, and we feel very confident that we can. We do understand, though, that the management fees will likely go up because of their higher costing assets that we're moving into. But as we said, we've modeled it net of those fees.
Okay. And how did you take into consideration real estate returns given, I guess, the next economic downturn and the impact of that on, obviously, that type of investment? And I was also curious in terms of how much value we lost in the real estate portfolio during the last downturn.
I can answer that. The last downturn, the loss in real estate was very large. It was 45%. And I think the one thing I want this board to think about within this asset allocation is by raising real estate to 15%, it has been a challenging asset class for CalSTRS history. You have to go back to about the late 80s, early 90s, but it was a real challenge to us back then because we had a very concentrated portfolio, literally in West Los Angeles. And then obviously 08, where we had too much leverage and too much opportunistic. So it's a challenging asset class, but we think because it's a hard asset, a physical asset, that will add diversification and help the portfolio versus going for economic growth. Almost all of our real estate return has actually come from lease income, not capital gains, because it's that kind of story of you get capital gains during a decade, but then you have a downturn and you lose it as the board knows, you adjusted the investment policy for real estate to be much more conservative, lower the leverage levels. So I think we have the right real estate portfolio, but from this current market, we're more of a net seller than a buyer. And we would set up a plan. Once you adopt the asset allocation, we'll come back at the next meeting with a multi-step plan, not year, but step plan. And I would envision it could easily take us 3 to 4 years to get to that allocation in real estate. You know, the current asset allocation, we're still not at the goals that were set 4 years ago. It was a significant change 4 years ago. We implemented over 50% of the change within 18 months, very quickly. But the other parts, real estate and inflation sensitive, or pardon me, private equity and inflation sensitive, we've been more of a steady investor and haven't chased those areas.
Okay.
Maybe just to add a few comments to what Chris said, that I think he hit the nail on the head with the fact that real estate is cyclical, while it can be diversifying because it will generate stable income over time. But the portfolio has changed dramatically from the last cycle and this cycle. As Chris is saying, roughly 70% of the vast majority of the portfolio is core, stable real estate assets. The leverage was, roughly, call it 44% or so in the last cycle, and it's currently 36%. So we've reduced the leverage, and there's a lot less value add and opportunistic which are on the higher risk end of the spectrum. So those were, I think that balances the viewpoint from staff.
Terrific. Thanks, Harry.
Thank you so much, Betty. And the answers to those questions, I think, were really helpful in terms of the time that it would take to actually implement, the cost associated with moving more into private equity, and our sensitivity and the work that we're doing around negotiating those types of fees and costs associated, the movement towards the collaborative model. And I think it's worth being sensitive to the importance of manager selection and the relationships in that asset class and in real estate in particular, that the disparity of returns that are created in those asset classes are dramatic. And the accessibility and the key partnerships is a driving force to the returns. And we have some control over those relationships. And I think the research shows if you're not accessing the proper relationships in those asset classes, we shouldn't be in them. So we've been able to access them. How do we protect and preserve them? Talking about competitive advantages, and those are things that we can control. And I think the dots connect throughout our meetings over the months and different items where we can see how important that is. So thanks for that line of questioning, but it was very helpful. Bill?
Thank you, Mr. Chairman. I have a couple of questions. Being a relative newcomer, it is, I think, helpful if for some of us to have a little bit of background on that. If you can go back to the last slide that was just up there. One of the driving forces here, at least I deduced that from the presentation today, which was terrific, by the way. The amount of work and effort that's gone into this is really impressive, and I join with the chair in admiration of the collaborative nature with which it has been done. One of the driving forces here is the expected funding status, and how do we get to the expected funding status? And the one determination that was made, instead of the lower return as opposed to the higher return, the 6.75 versus 7, was that there would be potentially an inability to catch up to meet that 2046 expected funding status. And I think it's helpful to understand some of the history behind how that came about, because I didn't know the history. And I think it's helpful to put it on the record once again, the amount of effort and how long it took, and the difficulty with which it was finally agreed to by all parties. And so if somebody can address that, I think it would be helpful.
In 3 minutes, David.
Yes, I'm trying to, maybe I'm trying to better understand what the question is, yes.
Just give me the history on how the funding status came about. I mean, in a paragraph or two.
The plan, the funding plan.
Funding plan.
Geraldine mentioned earlier about 0809. We all remember how the market dropped. Prior to this, CalSTRS was around 100% funded. I think if you look across the United States, most retirement systems were near 100% funded. Then 0809 came about. And again, if you look across the United States, most plans ended up near 60% funded. The difference between us and some other systems across the nation is at the time we lacked the ability to get more contributions to flow into the system to help to bridge that difference. Across the river at CalPERS, they were able to, so some of the funded stats recover a bit more quickly. For us, we were unable. And at that time, we started to talk with the legislature. If no actions are taken, we were down the path of actually running out of assets within a 30-year period, which would be unthinkable for a retirement system to actually have no assets to pay benefits. This is sort of what led to the lengthy discussion of we need a solution, we need a funding plan. And in 2014, that funding plan was adopted, but it did require some substantial increases in contribution rates, and many of them were phased in over time. The employer contribution rate has yet to reach its maximum. It's still being phased in. It was phased over a 7-year period. The state contribution rate did eventually reach the maximum. Members also agreed to pay more. Their contribution rates went up. And one of the key components of the funding plan is that it gave the ability to the board to adjust the employer contribution rate, and that was for the first time ever. And it also gave authority to adjust the state contribution rate by more than the board had in the past. And those were key components. And all of these play a key role here because as we discussed the investment return, the asset allocation and the investment return assumption, we are in fact also tied to that funding plan. The reason why, we've been talking about, it's not shown in the slide here, but if we were to make the decision, for example, to go to 6.75, our 2 at 62 members would have to pay more, about 0.5%, but the majority of the cost would have to be borne and paid by the state. They would experience about a 3% of payroll increase in the contribution rate. And this is the way the funding plan operates. And because we have limits on the state contribution rate by how much we can increase every year, the moment you do this, so I'll give you an example. If we have to, today the state is still not yet paying what it should we're not yet at the maximum contribution rate for the state because we can only increase it by 0.5% a year. So last May when we came to the board and asked the board to increase the state contribution rate, we did inform the board that we would expect to come back for another 3 or 4 years to ask for an increase. If we go to 6.75, we need to raise the state rate by 3%. Since we can only change it by 0.5% a year, that would take us 6 additional years to get to that point. So we're talking about a decade before we can reach the rate we need to. So then we would be looking potentially at a decade where if we have returns below expectations, we would not be able to collect more money than we need right away. So that's why the moment we go to 6.75, we start to reach the area where it's likely we may run out of room in the funding plan at some point. And as a board, you may have to decide, okay, if we go to 6.75, what should we do with the funding plan? So that's another thing to keep in mind. Hopefully that answered your question.
How long did it take to negotiate the funding plan?
Close to 10 years.
Why don't we allow Jack, this is a big part of, Jack, why don't you address this?
Yeah.
Just to add, David's had the advantage actually working in both systems and understands the rate setting process in both well. So I think he has great context to that. I would say there's pros and cons to both approaches, but our history with this kind of demonstrates where it's worked and also the weaknesses of this. Having the rates in statute for decades created very level expectations for school budgeting. And that's a good thing. Rather than a system that adjusts employer contributions 1 year at 10%, 1 year at 0%, 1 year at 5%, 1 year at 7%, which is the other approach where a board is adjusting those fluidly year in and year out. And there's a lot of pressures that come from that annual process. So for us, we benefited for years and years of stable contributions that held the system up well until we hit the wall. And then suddenly it becomes a political issue here because it's a legislative solution. So that's the other side of this. But I would, David, the issue with this actually was this started not with the recession of 2008-9, the issue with our funding plan. The issue started with the dot-com bust. And the issue was this board thoroughly assessed the deficit at that time. And at that time, we needed about 4 to 6 percentage points increase in contribution. But there also was a reasonable probability that the investment portfolio would solve the problem. So when we presented that issue to the legislature, you have to say, if we have a long-term vision of keeping this plan solid, we should adjust these rates now, not wait till these rates could be 15 points or 12 points. But right now, it's a 4 to 6 point problem. But I also have to tell you, there's about a 40% probability we'll solve it ourselves if the markets treat us well. Politically, if you're offered those alternatives, it's hard to win that argument, I would tell you, when you're faced with so many other priorities the legislature has to consider. Because if I said, wow, 4 out of 10 chances you're going to solve this, and I only have so many dollars to put on the table, probably you're not going to get those dollars. And that was the quandary for this system here. We demonstrated the case. We knew from a long-term perspective it would make much more sense to solve this then, and sure enough, it unfolded the wrong way. Then we had the recession. And suddenly this problem is magnified tremendously because of that. So if you added all those years, it really took almost 10 years of working it. And also it's a very valid issue for our stakeholders. They have issues of collective bargaining that are very real for them at the table. And it took a lot of effort for our stakeholders as audience to finally say, we see this problem the same way, and it's the number one thing to be solved. And that's ultimately what led to the solution, was getting everyone at that exact point of the cliff. But the statistic that I think won over everyone was translating this problem into a daily rate, if you will. And basically, myself, Ed Derman, who's now retired, and others that worked this, basically had to tell the legislature that every single day this decision is not made, it's another $25 million. Every day. You wait a week, you're at $125 million or whatever. So I think having the gravity of the situation at that cliff is what solved it, but it also made the solution much more expensive because of that. So I think we all have a lot of good lessons from this, for all of us and the stakeholders of making it work. But it was a long slog, and that's why I think all of us are now trying to think ahead of this much more clearly for everyone. Sure.
It's very helpful. I think it has been helpful for me to understand this better, and why the 7% as opposed to 6.75, why the greater risk. Yeah. But in fact, it's lesser risk if you look at the funding plan. One other question, and this is for Alan. In your summary of recommendations, you made a comment that the remainder of this memo describes a few key considerations and nuances the committee may deem worthy of further discussion and analysis. When I see that sentence, I would love for you to let me know what those might be.
We always focus on the downside. People call me the eternal pessimist, and I would just encourage you, when you look at these numbers, to always look at what we would call the left-hand side of the distribution, and what is the potential on downside risk, what will that do to contributions, and what is uncertainty. And urging you to really be very realistic and humble, and recognizing that the average is 7, but more than half the time, it will be less than that. And that's important for us to constantly reinforce that. I had one other comment that I wanted to address with your permission. And whenever there's a mention of full funding, people say, wow. Well, what people forget is full funding happened after the largest bull rally in the history of stocks and bonds in the world. In 1982, the long treasury bond was at 16%, and the price-earnings ratio of the Dow was less than 7. Over the next 30 years, the yield on that long treasury went to where it is today, which is 2%, so from 16 to 2, so that's beyond belief. And the Dow Jones has had enormous raise in the price-earnings ratio, where it's now in the mid-20s. And so the valuations just blew out, and there was global economic growth of enormous proportion. That created the tailwind for the extraordinarily good returns and that good funding level. What's happened since then is the capital markets have gone back much more to a historical average, and that's what we're looking at right now. I hope that answers your question, sir.
Thank you, Alan. My pleasure. Just one more, if I may, and for Scott. When you modeled the private equity portfolio, the return, expected returns, in terms of the collaborative, in terms of direct investing through the collaborative model, did you made the same assumptions with respect to fees looking backwards as you did looking forwards now? You didn't assume any reduction in fees that might be paid in the modeling.
That's correct, Bill. We wanted to be conservative in modeling, so we have not factored in our goal of saving roughly $300 to $500 million annually in fees due to the execution of the collaborative model. We have not factored any of that into these forecasts to be conservative.
And would it be possible to, at some point in time, to have an analysis of where you expect that to occur?
Yes, we could
quantify what we're looking at?
Yes, definitely. And I'd point to one of the pieces that Chris did, and I believe was it the May
July.
or the July meeting, where he put into a piece a modeling of the cost savings. That was an overall view, but we can break it down by asset class as well for you.
Great. Thank you. Thank you, Mr. Chairman.
Just to add, it was in the 10-year business plan in July, and then you'll get your cost report in November. And I don't know if we'll be fast enough to incorporate it in this one, but we can start talking about it within that report.
Thank you.
Great, thanks, Chris. Gail?
Thank you, and thank you, Mr. Chair, for making this an informational item, and then to the staff for the remarkable work, and to the consultants as well. I've learned so much, and I'm really grateful. I have sort of two areas of questions, one on the asset allocation, or a few on the asset allocation, and then some to the actuarial assumptions and to contributions. So the first on the actuarial assumption, obviously it's aspirational in terms of the constraints that we put into the system. I understand that the constraints will always dictate outputs, and obviously the constraints in the private equity classes, real estate and inflation sensitive, were fixed for both risk portfolios. So my first question is if it's possible to look at the moving private equity down significantly. I assume the model will just put everything into public equity, but I do think that's just an important data point in terms of seeing where we are in November, to have one more data point to change the constraints enough to see if it has any change.
That's right. So when we do this type of modeling, and particularly with respect to private equity, because public equity is sort of the best substitute to keep the return at least close to what we've modeled, definitely the change. And as we did some preliminary work on it, the shift, as you shift out of private equity, it goes to public equity. Because the alternative, I think, is even less desirable, in that in order to maintain the same level of return, you'd have to lower the diversifying class as well. And so, to the extent you make that change, it lowers the return, and it also lowers sort of the risk return trade-off. So basically the more private equity relative to public equity that we can put into the portfolio, the better our risk return profile looks, up to sort of a maximum of what we think is feasible to get into the portfolio. So there's kind of a couple moving parts there.
Yeah, no, that's helpful. I think it would be helpful to look at it because, in July 31st, we were at just around 9% in private equity. Last June, we were at 8% in private equity. So getting all the way up to 13, although a reasonable constraint so it doesn't all get pushed into public equity, I can understand that. And I understand some of the how we get there question comes later. But even is there enough opportunities in private capital to move from, we're shifting from these private asset classes all the way up to 34% with this huge emphasis on private equity. It would be nice to have sort of a preliminary snapshot of, and since this is only a 4-year asset allocation, just a preliminary snapshot of, are there different kinds of assets in private equity that perhaps haven't existed before? Are there opportunities in the collaborative model that haven't existed before? I think getting all the way up there in a saturated market, and to Mr. Keeley's point about the managers and having access to these managers at CalSTRS, I absolutely agree with, but just a little bit perhaps at the next meeting of the how, not just the reasonable number of the 13% constraint, but also the how we get there.
Yeah, no, thank you for asking the question, Gail. I think that private equity, if we were to look at our peer group, is probably in the U.S. pension fund system between 10 and 20%. So is it reasonable to have a 10% allocation? Is it reasonable to have a 13% allocation? Josh discussed the model and the direction of the model. Obviously, if private equity has been, and we think it will continue to be, one of the top performing asset classes, the model will always want to move in that direction, and it's going to look better on the risk return framework. But what you're saying is just revolves a lot more around our professional judgment, the judgment of Makita and staff. And do we think the premium that has existed will continue to exist going forward? Can we execute and indeed succeed in allocating 13% of our portfolio to private equity? So a number of those questions, I think, are lead to a more robust discussion, because these are the debates that we have around the table. So I'd love to, in the next segment in November, if the board chooses to bring forward that analysis for a 10% private equity, and why, what judgment has staff and Makita made relative to proposing a 13% allocation to private equity.
That would be very helpful, and obviously Makita and Steve Hart, who's here, the private equity representative from Makita, will be commenting on the pacing model and the ability to reach that 13% throughout public open session and closed session, I believe, later today. But Alan?
Just to address the thing, the answer is yes to your question. We, working with the staff, will come back and say how it would be implemented so that you would feel comfortable with the recommendation.
I appreciate that. Thank you. And then the thing that we don't talk about at all, and I just want to make sure I understand, because we hear, about divestment and having, obviously there's bills that go through the legislature that we'll hear about later, but some of them are obviously passionate, and there's a lot of thoughts out there. I do want to understand, just from an asset allocation class, there's no assumptions around divestment of any specific asset class. If there were to be that discussion, would that have a material impact on the portfolio you're proposing today?